terms of the cost, remember, this is a long-term assets, right? So the equipment in this question, so we are working on the question problem 9-3B on page 509. So the first question is asking about the cost of the machine, right? Remember, machine is a long-term asset, right? Why? Because this item can generate, future benefit for multiple years, for more than 1 year, right? So that make it to be a long-term asset, right? If you know that for long-term asset, we have to capitalize the cost, right? So remember, for long-term asset, we have a cost account. That's the cost you incurred in the initial acquisition, okay? So what consists of this cost, okay? What cost should be included, okay? Ruben, you have a question? No, okay. So, of course, there's the selling price, right? You have to pay for the selling price. You buy a car, you buy a machine. In this question, the cash selling price is 187,800, right? So this one has to be included as the cost. Okay, cash selling price 187,800, right? That has to be included. Okay. Format the cell to make it accounting, right? We are doing accounting. Okay, that looks better, right? Okay, so then that doesn't mean that you can use the asset, right? You have to bring the asset to your location for use. Okay, so you have to transport the asset from the whatever, right? The parking lot of the seller, right? And then to your own workplace. So there is a delivery cost. In this question, the buyer paid for the delivery cost. That is 1,200, right? So the idea is any cost incurred, okay, to bring the asset ready for use, okay, in your location, those costs will be included, okay? So this delivery cost will be included, right? Because without this cost, you are not able to bring the asset to your work location, okay? So here is 1,200. Okay, and then there's this 1 year insurance policy. So 1 year insurance policy on the machine. Do you think they have to have this cost in order to bring the asset ready for use? 1 year, it's for 1 year, right? Anyone?
Would it just be part of it?
Part of it, okay. Anyone else?
So it's not necessarily setting it up, but I think it's, could you still say that it's part of the initial because it's the first year?
Okay, so there are two options, right? First option is you could include the 1950 as part of the cost of the machine, right? The second option is you are going to expense this as insurance expenses, right? 1950. So if you capitalize it, right? So this 1950 will stay in the cost account of the machine, will be a part of the long-term asset. And then if you use expenses, right? This 1950 will be expenses, right? Insurance expenses. That will be in your income statement. You see a difference? Okay. Which way do you think is more appropriate?
In the expenses?
Expenses, right? This is more about maintenance, right? Maintenance. If I tell you, this is a very expensive machine, very fragile. When you ship it from the manufacturer to your workplace, okay, there is a risk this machine is going to break. Okay, I don't know what kind of machine would be like that, but let's just assume, right? So then, if I'm smart, I will be saying, guess what? I'm going to buy a 2-day insurance, okay, just to cover the transportation period. Okay, if that machine break during that transportation period, right, then I'm going to be covered, right, by the insurance policy. So let's say that the 2-day insurance policy cost me $100. Do you think I should include $100 as the cost of the machine, or I should expense it?
Yes, include.
Include, right? In that case, this cost, the 2-day insurance policy premium, is necessary for me to bring the asset to my current work location, so it can be ready for use, right? Because I really need to have that insurance. But this is different. In this case, this is the 1-year insurance policy, right? You can purchase this policy after you bring the asset to your location, right? So you set up your equation, everything works perfectly, and then you can buy 1-year insurance policy, right? What's the difference, right? So the idea here is, okay, the 1-year insurance policy is considered as part of the maintenance, right? Ongoing fee, right? Therefore, it should not be included, okay? It should not be included. If you read the textbook, right, under the equipment section, okay, in the textbook, chapter 9, under the equipment section, they give you one example. In that example, the 1-year insurance policy was excluded, okay, because it's ongoing fee, it's maintenance type of thing, okay. Next, installation and testing. So the installation and testing, that would be the $7,000. Do you think I should include it or not? 7,000.
Yes.
Yes, very good. Without 7,000, the machine is not ready for use, right? You have to make sure you install it first and make sure test it to make sure it's working properly before you use it, right? So if you avoid the 7,000, your machine is not ready for use, right? Therefore, you have to include this. So what's the cost of the machine? The cost of machine will be okay, the sum of these three. Okay, if I do a sum of these three, so that's going to be the cost of the machine. Okay. Are you able to see these numbers? Is this big enough? Do you want me to make it bigger? It's good? Okay.
I can see it, yeah.
Yeah. Does this make sense? The way how I determine the cost of the machine. The cost of machine, which you are going to capitalize, right, is not just the price, right? We tend to think how much I pay for the machine, right? You can't use it. You can pay this amount of money, but you can't use the machine, right? So this cost of machine, you include all the costs incurred to make sure your machine is ready for use, okay? That including your delivery cost and installation testing cost, okay? So that's our first question, okay? Determine the cost of machine. Second question. So this is A, okay, this is A. This is a problem 9-3 for B on page 9. So let's do B. For B, calculate the annual depreciation and the total depreciation over the asset's life using straight-line amortization, double diminishing balance depreciation, and units of production depreciation, which method caused the net income to be lower in the early years of the asset life, okay? So remember, when you have an asset, okay, and every year you use the asset, that helps you to generate revenues, right? But you also need to recognize the expenses. You also need to recognize the cost of using that asset, right? These things doesn't come from nowhere, right? It's not like boom, here, right? No cost. Well, this asset has a cost, right? Whenever you use it, there's the cost, okay? So it helps you generate revenue. Remember matching principle. you match the expenses against the revenue, right? Okay, so what is the expenses of using the asset? Okay, we call it depreciation expenses. Okay, depreciation expenses is to recognize that the cost is 196,000. Over the useful life of the machine. Okay, this is the cost I have to depreciate, right? Because eventually my asset will have zero value, right? Unless it's land, right? Land seems always appreciate in value, right? So unless it's land, okay? If you think about the regular depreciable asset, the value of the asset goes down, right? Eventually, it will be down to a salvage value or residual value. That is the money you can sell for at the end of the day. So whatever the difference, right? That's your expenses over the time. So you have to be able to allocate that decrease in the cost, right? The decrease in the value. You have to allocate that value across the period of the revenue generating, right? So that's the depreciation, okay? So basically, I have to allocate something called depreciable account, depreciable amount, okay, that equals cost minus residual value, okay? So how much it costs you, right? You paid for this, you paid for this, you paid for that. In total, you paid 196,000, right? On the year of the acquisition. So you are good for multiple years until the machine finishes its mission and you sell it for residual value. So what's the difference of the value decrease? Initially, the cost is this much, 196,000. And what's the residual value? Do we have a residual value in this question?
It has
No residual value, right? No residual value. That means at the end of the useful life, this is a garbage. You can sell it for nothing, right? You just dispose it, right? Nobody will buy it. It has zero value, right? So what is the depreciable amount? So the cost minus the residual value, that is the depreciable amount, okay? So in this case, my depreciable amount will be 196,000 minus residual value 0. So 196,000, that's my depreciable amount. I have to depreciate this amount over the useful life of the asset, okay? Okay. I have different methods. The first one is called a straight line depreciation. Well, it's pretty clear, just literally, you think about the word straight line, right? So basically, you recognize this over time evenly, right? You recognize this over time evenly. Maybe your consumption is the same, right? I use the machine evenly. Let's say the machine hours I used every year is almost the same, okay? So I think the amount of depreciation should be very similar. So I'm going to make sure they are even, right? So I'm going to use a straight line amortization. So what I'm going to do with this, so the annual depreciation, that equals, okay, depreciable amount divided by the number of years of useful life. Okay, so in this question, I know the depreciable amount, that's the 196,000, divided by what's the number of the useful life, number of the years of useful life. So in the question, the company estimate the machine's useful life will be 4 years. This is given in the question. will be 4 years. So every year, I should recognize the depreciation expenses of 49,000. Does this make sense? Does this make sense, everyone?
Yes.
Yeah. Okay. Awesome. Okay. Basically, let's take a look here. Let's say this is year 1. 4 years, right? Year 1, year 2, year 3, year 4, right? So let's say this account is cumulative depreciation. So in the year 1, you have 49. What's the cumulative depreciation? Well, the cumulative depreciation is 49,000. And year 2 is the same, 49. Oops. Year 2 and year 3, year 4, right? This is a straight line amortization. They are all the same, right? Same amount. But the cumulative depreciation, right, will increase because this account keeps track of the cumulative depreciation. So this one would be beginning balance plus this year's new amortization. So you can see this number will increase, cumulative depreciation. At the end of the 4th year, the cumulative depreciation is 196,000. Okay. And what's your cost? Your cost is always 196. Okay, so cost, remember you have 2 accounts associated with the depreciable asset. A cost account. Okay, what is the cost account? Is this number 196? It's a debit balance, right? So this number doesn't change. Okay, that's the recognition of the cost, acquisition cost initially. The cumulative depreciation will increase over time because every year you have depreciation, right? Over the time, the cumulative depreciation will increase. So in this case, you can see that every year it increased by 49,000. And at the end of the 1st year, it equals to the cost. So what's the net value? Net book value, or we call this carrying value, will be in the beginning, at the end of the 1st year, it's gonna be 147,000. 2nd year, 98,000. At the end of the 3rd year, 49,000. At the end of the 4th year, 0, right? Remember, this is the end of the useful life. The net value is 0, right? Does this make sense? The way how I set it up? So these 2 numbers will be reported on the statement of financial position, right? In the May term, you just prepared one of the financial statements, right? So for the cost, cumulative depreciation, these 2 accounts, that will be on the statement of financial position, okay? Do we have any questions before I move on? No questions? Yes? Good. Should I move on?
Yeah.
Okay. So now I'm gonna do the second one. I'm gonna do the third one. Okay. I'm gonna do the third one. So that's gonna be a units of production. Units of production method. So once again, the depreciable amount here, depreciable amount is calculated the same way. I know it's 196,000. Okay, that's my depreciable amount. This time I want to know how many units of production, okay, this machine can deliver. Okay, and then if I use the actual production for the current year divided by the total expected production units, that's going to be the percentage of use of the machine, right? So then I'm just going to use depreciable amount multiplied by the percentage of use. That's going to be the amount to be depreciated for this year. Okay. So in this question, assume the let's take a look. The equipment produces the following numbers units each year: 2,500 2018, 10,300 2019, 9,900 in the 2020, and 8,800 unit 2021, 8,500 2023. Okay, so units of production. So first, I want to calculate total expected unit of production. So this is easy, right? So I have different years, 2018. I'm going to add them up. Okay, let's take a look. 2018 until 2022, right? 2019, 2020, 2021, 2022, right? And I know the units production for 2018, 2,500, 2019, 10,300, 2020, 9,900, 2021, 8,800, 2023, 8,500. Okay, so what's the total? The total expected is gonna be, so I'm going to add them up. Okay, 14,000 over the 5 years. Okay, so I want now know the percentage of use, right? I use my actual units of production for a particular year divided by the total units of production. That's the percentage of use, right? So I use 2,500. That's the actual use for 2018 divided by total units of production. So that's this number. Okay, this number, I'm going to make it a percentage. Okay. Okay, I need a 2 decimal. So you can see 6.25%. Okay, that's how much I use it for the first year. So then I'm going to do the depreciation. So I use this percentage of use times depreciable amount. Okay, so this 6.25 times depreciable amount. So that's how much I'm going to depreciate. So I depreciate 6.25% of the depreciable amount. Okay. And now, what is the usage for the second year and last year? Oops, sorry. Okay, so what did I do wrong? Oops. Just give me 1 second. Sorry, I'm just fixing an error here. So you can see that for the second year, 10,300, lots of units of production, right? So you have a higher percentage, 25.75%, okay? And 24.75%, okay? And then you can calculate, and total that's 100%, okay? So now the depreciable, again, I use this times the depreciable amount. So you can see that in 2019, okay, 2019, so I will depreciate 50,470. 2022, I'm going to depreciate 41,650. In total, I depreciate 146,000. What's the cumulative depreciation? Cumulative depreciation. So the first year, just 0 plus this. The second year is going to be the opening plus the depreciation for the year. Did you see? At the end of the 2022, okay, the cumulative depreciation equals 196,000. And my cost is always 196,000. And my net book value or carrying value, so that's going to be the difference between the cost and the cumulative depreciation. So again, at the end of the 5th year, at the end of 2022, 0, okay, 0. But this one is interesting. 1, 2, 3, 4, 5. Yeah, because it's interesting, right? This question is asking, saying it has an estimated useful life of 4 years, but in this scenario, they have 1 year, 2, 3, 4, 5 years actually. So the question is not the greatest. I think if I would try to make it 4 years, right, to be consistent with the information. So for this units of production, does that make sense? You want to understand, calculate what's the percentage of the use of the machine based on the actual units production divided by the total expected production. Does this make sense?
Yes, I'm just kind of still typing things in, but it pretty much makes sense.
Yeah, I will post this one on the course website. Okay. So make sure you try to learn how to use Excel. It's a very useful tool, right? Very, very useful tool. Do we have any questions?
Nope.
No question. That's good. Okay. So that's the two methods. So remember, for these two methods, we are using this depreciable amount. And what is depreciable amount? Is the cost minus residual value. In this question, residual value is 0. In other questions, it can be like different values, right? 1,500 can be any numbers. Now let's take a look at the double diminishing double diminishing balance depreciation. Okay, let's take a look at this method. So you see the word double, right? Now you know that it's like times 2, right? Double, when you say double, what do you say? Double, double, right? When you go to Tim Horton, you say double, double, or whatever to order the coffee, right? So you almost think, oh, times 2, right? So now what times 2? So this one kind of related to straight line amortization. So in the straight line amortization, remember, let's calculate the base rate. That equals 100% divided by the number of years of useful life. That's your base rate. So we have 100 divided by 4, 25%. Remember, if this machine is used for 5 years, so for 4 years, so every year you amortize, you depreciate a quarter, right? So 1 divided by 4, right? A quarter. So a quarter is 25%. Does that make sense? Okay?
Yeah.
So this is the base rate. And now you calculate a depreciation rate. Here is double diminishing. You use 2 times. This is where the double comes from. 2 times base rate. 2 times 25%. Okay, so that equals 50%, right? So 50% is your depreciation rate. Okay. So now let's just copy this one. I'm going to copy this format. So the first year, the depreciation, you are going to use your cost. You are going to use your cost times depreciation rate. So what's your cost? Your cost is this number, right? Times your depreciation rate, 50%. Okay, so the first year, you are going to recognize 98,000 depreciation. And what's the cost? The cost is 196. Okay, so what's your net value? What's your net book value now? 96,000. Okay, because 50% is depreciated in the first year. Okay, what's your cumulative depreciation? So net book value now is 98,600. Okay, your cumulative depreciation 98,000. So now in the second year, you are going to use this number, the carrying value. Always use the carrying value, okay? Times, again, your depreciation rate. So the second year, you're going to recognize 49,000. What is the cumulative depreciation? The year 1 plus year 2. So now what's the net value? The net book value or carrying value is 196 minus 147. 49,000. What about year 3? What do you think how should I calculate it for year 3? If you know the number, tell me what do you think the number should be?
24,500.
Very good, right? Very good. That's good. Oops. Okay, sorry. Right, 24,500. What about your cumulative depreciation? At the end of the year 3. So the cumulative depreciation should increase, right? Should always increase. By what?
The depreciation of that year. So,
Yeah, 24,500, right? Very good. What's the balance?
171,500.
Thank you. 171,500.
Yeah.
And what's my carrying value? What's my carrying value at the end of year 3?
Uh,
25,000.
Okay. See, you take some time to calculate. I'm just drag, right? Look at that. I get my number. 24,500. Okay. So now, okay, now what is my year 4? What's my year 4 depreciation?
$12,250.
Thank you. Yeah. 12,250. Okay. And what's my cumulative depreciation at the end of the year 4?
$183,750.
Okay, so then very good, thank you. And then what's my carrying value? My carrying value is 12,250. But we have a problem here, right? We have a problem here. The problem here is, let's take a look. So the useful life, okay, so is the 4th year, right? They have 4 years of useful life. Okay, so 4 years useful life means this number should be 0, right? Right? This number should be 0 at the end of year 4, right?
Yeah.
So in the last year, you know, we work backward, okay? In the last year, we do this backward, okay? So what we're gonna do, this is how I do it, okay? So I know this number should be 0. And what this number should be?
196.
Yeah, this number has to equal to this, right? 196,000. And then what this number should be?
The same as year 3.
This minus this. Yeah. So basically, in the last year, okay, I will not do the normal way, 50%. My goal is to make sure my ending value equals residual value. So at the end of the year 4 is 0. That's the residual value. Okay. So now I'm working backward. So that means my total cumulative depreciation has to equal to the cost, 196,000. And last year, the cumulative depreciation is 171,500. So the difference, this 196 minus 171.5 would be my current year's amortization. Okay, so you can see this is called double diminishing. Double diminishing. So what double mean? You first calculate the base rate. Okay, that's 100% divided by the number of years of useful life. In this case, it's 25%. And then your depreciation rate would be double. Okay, double. So 2 times 25%, 50%. Okay, and then when you calculate your first year, remember you always use carrying value. Okay, so you use when you calculate depreciation. So here I'm going to write this down: depreciation expenses equals carrying value times depreciation rate. Okay, so carrying value, okay, will be in the beginning. There's no cumulative depreciation. In the very beginning, your carrying value is the cost. So you use 196. Okay, that's the carrying value at the very beginning. And then you multiply the 50%, you have 98,000. Okay, so now you amortize, you depreciate the 96,000. The carrying value is now only 96,000 left, right? You depreciate 50%, only the other 50% left. So that's the 98,000. And then you use 98,000 times 50%. So that's the 48,000 here. Okay, you see that? Can anyone tell me what did you observe the trend here? These first 3 years. What's the trend for the first 3 years?
I went down a lot.
Yeah, so went down, right? Went down a lot, right? So basically, you recognize a lot of expense, lots of depreciations in the early years, okay? And you, as the time goes, you recognize less and less depreciation. What kind of asset do you think would fall into this category? They will generate more revenues in the beginning. Think about the asset, the ability to generate revenues decrease, diminishing over time. What the asset would be?
Definitely vehicles lose their value quicker
Okay, yeah, good.
in the first couple of years.
Yeah, what else? Computers?
Definitely.
Yeah. When you first buy it the first year, right? It's so exciting, right? I have a new computer. You enjoy the benefit, right? And then they have a new technology, right? They are faster, more RAM, right? You know, so then your computer is not like that valuable anymore. So it's always the first couple of years. Computer, people say you have to get a new computer every 3 years, okay? Because then, you know, it costs money, right? $700, $800 for a regular computer. But think about if that can save you time, right? Because your time is so valuable. Imagine like if your computer is slow, how frustrating that can be, right? So if you are considering buy a new computer, I think do it, right? Even though it costs some money, but it's gonna save you a lot of time, right? And the time is the money, right? So yeah, so in this case, you understand, well, for those type of assets, right? Basically the pattern of revenue generation. If they generate revenues in the early years a lot of more than the later years, maybe the double diminishing balance depreciation would be a good way to do the depreciation, because you want to have a good matching expenses to revenue, right? If you use it, if the revenue generating is very stable, okay, it's very stable, then maybe you should amortize it over, you know, over Streamline Amortization, right? It's an even, right? So the machine generates revenues evenly across the useful life, right? The years of useful life. And this one is based on units of production, right? Let's say my machine can be only used for 200 machine hours, okay? And then if I used 20 machine hours for this year, so I used 10%, right? So 200 is the life, right? 200 machine hours is the life. If I use the 20, so I use the 10%. So then just apply that 10% to the depreciable amount, right? So you see the case, right? You know, how we can use and think about the vehicles, right? If I have a American Dodge Caravan, the estimated mileage would be 200,000 mileage, right? If this year I used, in the first year, I was so excited with the new car, I use like 60,000 kilometers. That's my mileage. So I use 60,000 divided by 200, right? So that will be 30%. So the first year I use 30%. So then I use 30% times the depreciable amount. That's my amortization, depreciation, right? So these are the three alternatives, right? There's no right or wrong, right? There's no right or wrong for accounting purpose, okay? For accounting purpose, you have these different alternatives you can pick, right? Sometimes they would recommend that you try to pick the method to approximate the trend of the revenue generation, right? So that your depreciation expenses follow the same trend of revenue, right? That's because of matching principle. But for CRA, for tax purpose, CRA has very strict regulations, okay? CRA will say, well, machine, okay, this type of machine, they put them into a class and they tell you what's the percentage of depreciation, okay? Just to fill up those loopholes, right? Because people will take advantage of this kind of calculations to pay less tax, right? But CRA will make this very clear and very strict. If you own a truck, right, 4x4 or pickup, whatever, and that belongs to this class, you amortize with 20% rate, right? So it's pretty clear in the CRA Income Tax Act, right? That's for the tax purpose. For accounting purpose, okay, the depreciation has a little bit of flexibility, but the recommendation is still to, make sure the pattern expenses, the depreciation expenses pattern follows the revenue pattern, okay? Matching, right? Matching. Okay, now you can anyone tell me that which method caused net income to be lower in the early years? Which method caused the net income to be lower in the early years?
Total expected unit production.
This one?
Yeah.
This one, the first year you depreciate this amount, right? So that's your expenses, right? The
Yeah.
first year's expenses, I'm gonna highlight them under different method. So for straight line, the depreciation expenses 49,000. For units production, 12,250. For cost of, for double diminishing balance depreciation, that's 98,000. So under which method you have a lower net income?
So lower net income, or so the higher expense, is that what you mean?
The question is asking the lower net income.
But we don't have the net income, so we're really just looking for the highest.
Which one is lower? Yeah, you just compare which one is lower. You don't have to calculate the actual net income. Okay,
Right.
We don't have enough information. But just compare under the three method, under which method you will have the lowest net income. For year one. So you compare these three numbers, right?
So double diminishing then.
Very good, right? So double diminishing has the highest year one depreciation expenses. Your expenses is higher, you have a lower net income. So under double diminishing balance, this method, you're gonna have the lowest net income, okay? In year one, right? In year one. If you think about let's take a look. In year three, okay. Sorry, I'm just highlighting these numbers. So year three, if you compare these numbers, which method would have the lowest net income for year three?
Streamline depreciation.
Good. Streamline amortization, right? Okay, how about you think about the entire life of the useful life? If you think about the effect of depreciation, okay, think about within that multiple period that's over the years of useful life. Does it matter which method you use? No, right? Because the total depreciation is the same, right? So over the time, your objectives is to recognize 196,000 depreciation expenses, right? So regardless under which method, that's your objective, right? Right? So your objective is to recognize $196,000 depreciation expenses in total over the multiple years, right? Okay, so then if you consider that period as together, then it doesn't matter which method you use, right? The total expenses for those years together is still 196,000, regardless of the method, right? However, the allocation is different, right? You can see the allocation is different. This one, they allocated evenly, right? They allocated it evenly. This one is fluctuating, right? Depending on the percentage of the use of the year. This one is really fluctuating. And this one, you recognize more in the early years, okay? You recognize more in the early years. But at the end of the day, the total depreciation expenses you recognized is always 196,000, okay? It's just, when you allocate into each year, that allocation is different, okay? Because the allocation is different, that result in the income is different, right? So if you think, if you want to have a lower income, you don't want to pay tax, you say, oh, in year one, I'm going to use double diminishing balance depreciation because this gives me lower income, right? But guess what? In year three, you're going to have higher income, right? So you see, you are not winning by using one method, right? It's just the allocation, right? All right. Do we have any questions?
So pretty much for the double diminishing, if you just kept doing the 50%, it would never actually fully diminish because it's on like a curve, right? So that's why on the last year you have to just subtract it.
Good point, right? I'm not sure you guys know about the derivatives and the integration, right? In the advanced mathematics, right? So the whole point is like if you have a thing, it keeps you divided in half, right? You can never finish it, right? If you have a stick, every time you divide it in half, right? If you keep cutting it in half, you will never finish this process, right? So it's endless, right? It's endless. So in the last year, you have to use the approach that you work backward, right? In the last year, because you know what's your ending balance, right? So you work backward to figure out what's your amortization.
Okay, that makes more sense. For a second, I thought it was like the question was weird, but it's you would never get there.
Yeah, because all the years you follow that pattern, right? The same depreciation rate until the last year, because otherwise it will just keep going, right? It's never ending, right? So you have to put it, because the balance, the salvage value, the residual value, right? So you are shooting for that value. That's your goal for the end of the last year, right? Anyone have any other questions?